Okay, I am going to cover the cash budget in this lecture. And for those of you taking score, I've eaten lunch. I just finished lunch, so I have like a good 2 hours in me until I start thinking about dinner. Um, and as a surprise, I mean, it's not really a surprise. Well, I guess it is. Um, I got a tattoo today. For those of you that love accounting and tattoos, I got the accounting equation tattooed to my inside of my arm. A equals L plus E. Assets equal liabilities plus equity. I would say I'm the only person on the face of the planet with the accounting equation tattooed to their body, but I actually know somebody else who did it, a former student of mine. Fucking crazy. And that student did the full blown assets equals liabilities plus equity. Um, man, that's crazy. But anyway, I did mine, so we are now two of the club. I would be shocked if there was anybody else in that club. Anyway, cash budget. Okay. The cash budget is literally, we've gone through it's a part of the master budget. We've gone through the sales budget, and then we went through the production budget. We went through direct material, direct labor, variable overhead. That's my wife. I'm going to take this call. I'll be right back. All right. Everything's good. Whew. There was a time in my life years ago, like 20 years ago, um, maybe, yeah, I guess it was about 19 years ago. Uh, my daughter was born, just born, newborn baby, super colicky, cried all the time. We never slept. It was so stressful. And at the same time, I had this massive case I was working on. Um, and it was a huge case. It was going to trial. And so I'd be working and my phone would ring and I would just like close my eyes. Man, my wife would kill me if she hears this. But I would be like, fuck. Like who's calling with a bigger headache? My wife or the partner on this case that I was working at? And I would just like close my eyes and reach for the phone and just pray to God that it wasn't going to be total mass hysteria on the other end. But yeah, anyway. So now when my wife calls, my kids are teenagers. One lives in Chicago. So things are pretty stress free. There's very rarely when some major issues going on. Now it's usually what's for dinner, how's your day going, miss ya, love ya. Good stuff. Anyway, back to, man, I'm already 3 minutes into this lecture and we haven't started even talking about anything. Okay, the cash budget. We do the cash budget after we have a good sense of the sales budget and the operating budget. Whether we do the financial statement budgets first, before this, or after this, not too sure. Doesn't matter so much. But the cash budget, okay? First thing that we're going to do with the cash budget is we're going to sort of figure out what our cash needs are with respect to capital expenditures, right? So the machinery and equipment, new investments. Are we selling any land? Are we selling equipment? Are we buying new land? Are we buying new machines? All right. So the first thing we're going to do is we're going to reconcile the cash that we're going to use to purchase new machinery. And in this particular example, it looks like in December, we're going to use 25,000 in cash to purchase new equipment. Now remember, the equipment could be a total of 60,000, okay? But we could choose to finance some portion of it, right? So we would take out a loan. And then in this example, we could spend 25,000 of our own money to purchase equipment. So we're not saying that we're purchasing equipment that is worth 25,000. We're just saying we're purchasing equipment and we're using 25,000 in cash. Okay. In addition to the uses of cash, if we were to sell something, there would be positive additions to cash. But the real heavy lifting with respect to the cash budget is this schedule. Okay. What we really want to do is we want to start with beginning cash, and that's really going to come from, the balance sheet from the previous year. And whatever I ended last year with will be my beginning cash balance this period. Then I'm going to add up all the cash receipts, all of the things that we do that are going to generate cash. And in financial accounting, we talked about cash receipts being, it depends if we're talking about cash from operations or capital expenditures. In this framework, we are really looking at all cash receipts, not just from selling our goods and services, but in addition to selling our goods and services, are we selling any other assets for cash, like machinery, plant and equipment, land, and so forth? But we're pretty much going to add up all of the cash receipts. We're going to take away from that all of the cash payments that we anticipate using, all the operating expenses, direct material, direct labor, et cetera, et cetera. But every use of cash we're going to have in the cash budget. And then it's going to give us a preliminary cash balance. And the reason why we want to say preliminary cash balance is because what if it's the case that I start with, I'm going to keep things super simple, but what if I start with $20 and then my cash receipts for the period are 5, and then I'm anticipating using 35,000, sorry, $35. Well, then I think my preliminary cash balance would be negative $10. Okay. And I obviously can't have negative $10. And so what I would want to do is say, after I calculate my preliminary balance, if I don't have enough cash, if I'm not hitting some minimum amount that I feel comfortable with, then I might have to go borrow money, right? So I'm going to borrow money. If I end up having way more cash than I need, right? So it could be the case that I have 5,000 in cash receipts in another period, and then I'm going to I have a cash beginning balance of 5,000. I'm going to have cash receipts of 5, and then cash budget payments of 5. My preliminary in that second period is going to be 5,000. And maybe that's way more money than I actually need. Sorry, way more cash. I don't need that much cash. So maybe what I would do in that situation is I would repay any of my loans that I had taken out from a prior period. Okay, so preliminary cash is the amount of cash that we have before any financing decisions. And then after the preliminary cash plus or minus my financing activities, that will be my ending cash balance. Okay. So cash receipts. Let's start thinking about cash receipts. So in this particular example, we could look at October. We have $60,000 in cash. Sorry, I misspoke. We have $60,000 in sales. Okay. And what this schedule is saying is, hey, you know what? 40% of my sales are done in cash. So customer comes into my store, and well, I should say 40% of my customers come into the store and use cash, and therefore the actual cash that I generate from sales of this month, 24,000. All right. And then 60% of my sales are on accounts receivable. And so in this particular example, my accounts receivable would be, what is that? God, I'm so bad with math. 36,000? Okay. That's for the month of October. Now, in October, right? In October, you know what I'm going to do? Again, I just said I have a bunch of cash sales from sales that I made in October. But then in October, I am going to collect some portion of the September accounts receivables. Okay. So in September, I could do the same thing. September, I had 42,000 in sales. And as per usual, 40% of those were in cash and 60% were accounts receivable. So if 60% were accounts receivable and 42,000 in total sales, then I think I've got 25,200 in accounts receivable from September that I'm going to collect in October, right? So this is my, what is it, September 30th, 2000 something. That's my accounts receivable balance. And I'm going to collect that in October. So I'm going to collect my September sales on account and my October cash sales. And therefore, total October cash, 49,200. And I bet you anything, it's going to work the same way in November. Okay. In November, I've got 48,000 in sales, 40% of 48,000, 19,200. And then the portion of my October sales that were on account that I'm going to collect in November, 36,000. And that's exactly what we were saying here. Okay. That's cash receipts. Usually pretty straightforward. Come on. Oh, okay, fair enough. Cash receipts, right? This is what we just went through. In a different scenario, okay? In a different scenario, it could be the case that I'm not going to collect all of my accounts receivable, and I'm not going to collect all my accounts receivable in the following month. In this particular example, in this second example, we're basically saying, listen, I have October sales, okay? I can have October sales, and my October sales were 60,000, okay? Some portion of that is going to be cash, right? So if the assumption is 40% of my October sales are cash, then I could have 24,000. Okay. Then it could be the case that I am going to collect my accounts receivable, the remaining amount, right? So 60% of 60,000 is 36,000. Hopefully I'm doing the math right. Okay. So 36,000. Listen, I'm going to collect some portion of that in November, the next month, and then I'm going to collect some portion of that in December. Okay. Rather than collecting it all in the following month, I'm going to spread it out across 2 months. So what we're saying in this second example is 60% of our credit sales are going to get collected in the following month. All right, sorry. 60% of our sales are going to be on account, and 80% are going to be collected in the following month, and then 15% will be collected 2 months out. So if I look at the footnotes, okay, I'm going to say December sales, 84,000. I'm going to collect 40% of that. So the December portion of sales is going to be 33,600. Then I'm collecting, right? We said 60% of 48,000. Let's do the math over here. 48,000. And then 60% of that is going to be on account. So 60% 40. Okay, 60% of 48,000, I'm coming up with 28,800. And now this is saying, hey, listen, my November sales were 48,000. 28,800 were accounts receivable. And then I'm going to collect 80% in the following month, so December. And then in January, I'll collect the remaining 15%, right? That only gets me to 95. So what they're saying is generally we never collect 5% of our accounts receivable. So if I were to do 80% times 28,000, I'm coming up with 23,040. Okay. And then in January, if I had the January schedule, it would be this path. Okay. However, in December, remember, I'm going to collect 15% of my accounts receivable from 2 months ago. And so I am going to collect 60% times 15% times 60,000. So my accounts receivable balance at the end of October was 36,000. And then I'm going to collect 15% of that 2 months out, and therefore 5,400. It's the same concept, cash sales as opposed to credit sales, but now we're just saying the credit collections is going to take place over 2 months, not 1 month. And unfortunately, we're probably not going to collect all of our credit sales. Okay. Okay, cash payments. A few things that we want to highlight. The first being there could be differences in timing, right? So when we are going to pay for certain things that we use in operation. And so in this slide, the schedules are essentially the same thing, but two slightly different assumptions, just like the previous example, right? So we're talking about direct materials in both slides or portions of the slide. However, in the top graph, we're basically saying that we are going to pay for the purchase of materials in the month following the purchase. Okay. And so if I purchased $7,060 worth of material in September, then I'm going to pay that in the following month. Likewise, if I purchased 10,240 in October, I'll pay that in November, right? The first assumption is that we're not going to pay anything until the following month, right? So again, we can purchase and we can just put it in accounts payable. The second scenario is which is more likely the case. It's usually the case that we're going to pay a little this month and a little the next month, right? So think about October purchases, right? So if I purchased on October 1st, the bill for the October 1st could be due by the end of October. So in this example, we're going to pay 20% of the purchases in the same month. So if my purchases were 10,240 and I'm going to pay 20% of that with cash, then I've got 20% times 10,240, 2,048. And then I'm going to pay 80% of the previous month. And so if the previous month's purchases were 7,060 and I'm going to pay 80% of that in October, then 80% times 7,060 is 5,648. Okay, for a total of 7,696. Seems fairly straightforward. Fairly straightforward. Okay, so moving on. This is the entire schedule put into action. Okay. So again, we have cash receipts in this particular example. In October, we're going to start with 20,000 in cash. I might just blow this up a little bit. And then we're going to total up our cash receipts, right? Again, it's the cash, sorry, it's the sales in October times whatever percentage of October credit sales we collect in October, right? Plus whatever portion of cash sales are made or sorry, yeah, are collected in October, right? So October could be October sales are, I don't know, could be 60,000, and some portion of that will be cash and some portion of that will be accounts receivable, and then we will collect some portion of accounts receivable in October, and then we can collect some in November, and maybe we would even collect some in December. Right? So what we're saying is the total collections from sales, 49,200. Therefore, all the cash we have available to us for the month of October, 69,200. Then I'm going to go through all of my payments, okay? I'm going to go through material. And it could be the case that my material purchases, the cash payments related to material purchases could be some portion of purchases from this month. And then we could also pay for some portion of purchases from the previous month, etc., etc. The only thing that I would highlight maybe in this list of things that we would pay, right? So we've got direct material, direct labor, and then I have variable overhead. That seems reasonable. Sales commission, sales salary, administrative. I'm probably going to have fixed overhead, right? I feel like if I'm paying rent, I'm going to pay some portion of my fixed overhead. What I would encourage you to pay attention to in this section of the cash budget in the homework, one would be depreciation. If you're looking at depreciation as an operating expense, we want to remember that depreciation is a non-cash expense. So it's likely the case that we will never pay for depreciation because it's a non-cash expense. The other thing I would probably point out is that things like property taxes, right? So I've seen questions that said, hey, you know what? Your property taxes are $200 a month, and you prepay your property taxes or you pay your property taxes for the entire year in January. Okay? And if they're showing you a schedule like this where you've got 3 months, even though there are only 3 months in the schedule, you got to make sure that if they're talking about January sales or January cash and it's 200 a month for the entire year, then the cash payment in January would be 2,400. It would be the 200 per month times the 12 months in the year. Okay, but property taxes and depreciation are usually the two expenses that give some students a hard time when it comes to reconciling the cash budget. And then I would just point out that in this particular example, we are borrowing money. And so we borrowed $10,000. The annual rate is 12%, and therefore the monthly rate is 1%. So again, when you're doing the homework, I would definitely make sure you understand the time period that you're calculating interest for and what the annual rate is. Okay? Then, this is the last thing I want to talk about down here. So in our particular example, okay, in our particular example, The question somewhere is telling us that the minimum cash balance that this company wants to have is $20,000. Okay. So if they come up with more than 20,000 in the year, whatever is in excess of 20,000, they're going to use to pay off any loans that they have. If they come up less than 20,000, then they're going to borrow what we need to borrow in order to bring the cash balance up to 20,000. So in this particular example, we go through cash receipts, we subtract out cash payments, we include the beginning cash, and what we're saying in October is that the preliminary cash balance is 25,635, and we only need 20 like we said. Therefore, we're going to make a payment. We're going to pay off some portion of our principal amount owed. Okay. And therefore, we're left with 20,000. And this right here is basically saying, okay, the loan balance heading into the month of November is 4,365. Then if we look at the preliminary balance in November, we've got 43,000. And we said, if I have anything in excess of 20,000, I'm going to use that to pay off my debts. However, we just said the previous month of October, the outstanding accounts payable was only 4,365. So even though we have more than 20,000, way more than 20,000, we've only got 4,365 in debt. And therefore, that's all we're going to spend on our loan. And therefore, we're going to end way over the minimum amount. And then the same thing's going to happen again in December. Our preliminary is 44,000. We have no debt, and therefore our ending is 44,706. Cash paid for interest. Usually it's the case that anytime they give us an interest rate, it's always an annual rate that we have to then convert to a monthly rate. So I would really pay attention to this in the homework. Make sure that if they tell you the interest rate is 12%, that would seem kind of high to me for an entire year, for an entire month. So an annual, and let me back up. Generally, we see interest rates stated in annual percentages. Okay, so in this particular example, they've already converted an annual amount to a monthly amount.